the deal making has really ticked up in a very meaningful way. There's four main deal categories that we as a firm are focused on and that we're observing.
What do you think, Chris, are those signs that a creator business is ready to scale?
What buyers really want to see is, do you have a diverse client mix? And is the value of each customer growing over time? And do you have good customer retention? And then do you have really efficient ways to acquire and service those customers that allows you to drive profitability to the bottom line?
Before, the playbook was give away free content for years and years and years and then monetize. You can monetize much faster now. That's going to give you a really meaningful business if you do it properly and deliver properly.
Content is the new universal truth to acquire customers at scale and efficiently, more so than like paid media marketing that we knew from like 10, 15 years ago with the whole growth of all the D2C businesses.
Hey everyone, welcome to the Creator Ops Podcast. I'm your host, Thomas Schreiber. The goal of this podcast is to educate you on becoming a great operator in the creator economy. On today's episode, I sit down with Chris Erwin, the founder and CEO of RockWater, to break down how capital is flowing into their creator economy and what this new growth cycle means for creators, operators, and acquirers. Before founding RockWater, Chris began his career on Wall Street doing media and telecom M&A. He later joined one of the first YouTube MCNs and social agencies as COO back in 2012, where he helped co-lead the sale of the company in 2014. They're known for having one of the deepest deal pipelines and most detailed understanding of digital business models in the market. In our conversation, Chris and I unpack why 2025 feels like the start of a new growth cycle in the creator economy and where billions of dollars of investment are starting to flow. Chris breaks down the four major categories of creator economy M&A and what's driving deal activity in each. We talk about why strategic buyers from agency holding companies to CPG brands are suddenly acquiring creator-led media and IP. Chris shares what creators should consider before taking on capital, from dilution math to growth expectations to partner selection. We go deep on the signs that a creator business is actually ready to scale and the red flags that immediately turn buyers away. And finally, Chris shares lessons from dozens of deals and what he believes the next wave of creator-led companies will look like. And now, without further delay, here's my conversation with Chris Erwin. You've mentioned before that 2025 feels like a new growth cycle in the creator economy in terms of investing. What do you think is driving that feeling for you, Chris, right now?
You're right. I do really believe that it feels like in 2025, we're entering a new growth cycle for the creator economy industry. And I think it's important to step back and just understand the context a bit, right? So if you look at macro trends, you're seeing that over the long term and going forward. We're in like generational media and consumer behavior disruption. So linear TV viewing is just completely like falling off a cliff, and it's all going into digital and in particular social media environments, and even more specifically social video. So as consumer behavior is changing, then the revenue follows that, right? So you're seeing kind of like a downfall in TV advertising and media spend going into social media, programmatic, direct advertising, but also particularly influencer marketing spend is really skyrocketing, right? It's forecast to be over 15 to 20 billion plus globally and growing at like 10 to 15% plus per year. So then capital follows revenue activity. And so as a result of that, I think, we're seeing billions of dollars enter into the space in a lot of different categories. And that's really exciting. But the context was like, and I got into this space, I started my career on Wall Street like 20 years ago. So I saw like a lot of the early digital media and cable telecom deals. And I think, prior to 2022, there was a lot of investment. I call it the first growth cycle was like 2014 to 2022. And I was working at one of the earliest YouTube MCNs as part of that. And then, helped sell that firm. And it was wild. And there was a lot of different business models that were funded. A lot of different investors came into the game. Venture investors, family offices, high net worth individuals, private equity. Everyone was just trying to figure it out. I think we really got to a period of like irrational exuberance where by the summer of 2022, at a point there was like massive investor mismatch. There was solutions in searches of problems, which is never a good way to build a business. There was not a focus on profitability and really sustainable scalable systems. And so there was a big capital pullback, right? There were shutdowns, there were fire sales, there were bankruptcies, but still I'll call it like the top 20% of businesses still were getting funded and we're doing these like very large exits. But now what our team is seeing is that starting in the second half of 24, and particularly for the first half of 25, the deal making has really ticked up in a very meaningful way. I think we saw one in the first quarter of this year, creator economy fundraising, as reported by the information, was the most amount of capital into the space in like the last three years since 2022. And then you're seeing these landmark deals that I can talk about. There's kind of four main deal categories that we as a firm are focused on and that we're observing. And there's some specific trends within each of those categories that I can speak to. But yeah, like the takeaway, and I'll pause here because I know I've been rambling for a bit. Well, the takeaway that like, when I toast at the events that we do, I tell like the space, it's like you're in it at the right place at the right time. And it's really, really exciting for everyone involved.
What do you think I know you listed some of those mistakes that happened between that 2014 and 2022. What are those trends and areas that the capital is really interested in? What have they learned that to not do, to not invest in as they kind of get into 24 and 25?
I think there's some general themes that apply to all business models, and there's ones that are certainly specific. So I think, it's a focus on fundamentals, right? It's very easy for people to talk about sexy KPIs like, like how big is your audience or how big is your subscribers, and kind of like these manufactured financial metrics that don't really matter. But at the end of the day, businesses need to drive revenue and need to make profit, right? What we tell our clients to really focus on, and the deals that we observe, what's really driving outsized company and deal valuation performance, is getting into a certain critical mass and size of revenue, having growing profitability margins, having a high quality team with good leadership that is scalable. For media companies in particular, it's having high quality IP that can be extended onto other platforms. Say if you start on YouTube, kind of make its way into live events or consumer products or into streaming and film and TV. And then also for a lot of the talent representation businesses, like high quality talent. And for agency and marketing services, do you have high quality clients with recurring revenue models with low customer churn, and being really mindful of, call it, revenue concentrations? Like, I think I see more P&Ls in this space than like anyone else out there. And you can see a P&L and be like, oh my God, that's like $10 million in top line revenue. They're growing 30% year over year. How exciting. But then it's like, oh, one customer makes up 80% of that business. That can be kind of tough,
And where are you seeing those in those types of P&Ls? What type of model are you seeing that particular issue in?
And it's in a lot of, call it, like digital marketing and advertising services, right? And so there's a variety, right? You could be doing branded content, influencer marketing, social media management, PR, like you name it. And what buyers really want to see is, do you have a diverse client mix? And is the value of each customer growing over time? And do you have good customer retention? And then do you have really efficient ways to acquire and service those customers that allows you to drive profitability to the bottom line?
I want to jump ahead to the exit really quick. Who are those types of people that are looking to make some purchases for those types of companies? And in particular, do you feel like the typical representation agency or, social media agency that is shifting from, there was a lot of interest around those and there continues to be acquisitions of those, but more dollars going into individual creator businesses versus that typical agency style?
Let's break it down by category. I think that'll be helpful, right? So, I'd say there's four main M&A buckets that we're focused on and that we're tracking. So one of them is talent services. So working with different, call it modern and traditional talent to build 360 businesses, connect them with advertisers, and really build long, sustainable careers, and a variety of other things. So in that space, there's a few themes. One, I think we're seeing large private equity really get interested in, call it, the talent management space. So if you look at in talent representation, the traditional talent agency space over the past 15 years, it was very consolidated. Private equity came in, backed a lot of the major players. They bought up a lot of their competitors and peers, rolled them up for incredible scale, and then exited. So firms like TPG that backed CAA and sold to Artemis made like billions of dollars, right? There's many examples there. So I think private equity is saying, like, that playbook worked really well for us and our LPs. We're seeing the same fragmentation dynamics in the talent management space. And in addition, within management, there's this whole new wave of digitally native creators that need new services that are growing really quickly. And so we're going to make a play there, right? An example is like Carlyle, large private equity firm that just backed Entertainment 360, a traditional Hollywood management firm. And we even just saw Coral Tree buy a minority stake in innovative artists, right? So that's like one theme within the talent space. I think a second theme is that you're starting to see this hybridization of digital talent management businesses with IP creation and digital studios, and they're raising funding. So this is like Fixated raising $13 million from Eldridge, or Unicorn Management that's raised $900,000 from Powerhouse Capital, right? One other key theme that we're seeing is these like Hollywood studios are also saying like, hey, we're going to build out large talent divisions. And we also want access to this new modern wave of digital talent, because if we want to better market our vehicles and our projects, like we need digital talent on board. And also there's some of the new storytellers and new tastemakers. So we want access to that like development pipeline. That's why Propagate just bought Parker Management. Now they own 4 distinct talent management brands under one roof. And you had Skybound behind The Walking Dead. They just bought 9-4 Entertainment, another digital management firm. So there's a lot going on in the talent space between strategics and financial sponsors. So that's one. I could talk about influencer marketing services, but I'll pause there and see if you have any questions.
Yeah, no, keep going on the other categories, because I'm curious. I think it's a helpful breakdown and a helpful level set for the audience.
So then you have what we call like influencer marketing and call like creator tool and technology businesses. So a few themes there is that you have the large agency holding companies starting to be really aggressive buyers, because the majority of their revenues and fees come from selling like TV media. But with TV audiences declining and falling off a cliff, like they're going through an existential crisis. So Publicis, large agency holdco, has done 3 major deals buying influencer marketing platforms over the last 9 months. So they bought Influential for $500 million last year, which includes earnout. They then bought that exact same business model in Latin America, BR Media. And then they bought Captivate, I think within the last couple of months, for $150 million. And then they've said that they have like another $1 billion for acquisitions. So they're being very aggressive, and that follows what WPP did 2 to 3 years ago, buying like Village and Goat and Obviously. And then, I think it's funny because we're writing about one of these deals that was just announced over the past week, but there was the sale of Social Snowball to Dot Digital. So like social media management, influencer and marketing and affiliate services. Dot Digital is a marketing and automation services company. It's like, hey, our clients want to, if the future is building social channels and influencer marketing, we need to offer that service. So they did that deal, and that was pretty high valuation. I think without earnout, that was like 6.7x revenue. And then the one that we're writing about right now is Group One, this like Swedish diversified digital services portfolio. They do like digital marketing services and website hosting and more. They just bought this company out of India called Social Pilot that does social media management, scheduling, and other services. What's exciting is that I think it was for $50 million, and they raised 2 founders, no outside capital. So it's an exciting story. So that space, there's just a lot of activity that's happening. There's 2 more buckets. So why don't we keep going?
Keep going. We'll get to some. I promise I'll get to some questions, but I think this is helpful.
Just hope I had something left for the questions,
Exactly.
So the next is social publishers, right? So these are companies that are creating IP and content for social media distribution. And I think some interesting things here is if content really is, there's a whole bunch of new buyers that are entering the space other than just like endemic media companies. So if content is the new universal truth to acquire customers at scale and efficiently, more so than like paid media marketing that we knew from 10, 15 years ago with the whole growth of all the D2C businesses, then it's causing companies like Wonder, a food services business, to acquire Tastemade, a food media business, right? And then a fintech company like Robinhood to acquire financial media businesses like Charter, the newsletter, and Snacks, the finance podcast. And then we're even seeing this with like a gaming publisher out of India called Nazara buying like esports media companies and more. So that's interesting. And then, yeah, and you're seeing, I think also traditional entertainment companies starting to really pay attention here as well. So like it's kind of it blends categories, but like Fox Media just invested in Whaler in one of their like divisions, and then you had Fox also make an acquisition of a podcast and D2C media business called Red Seat Ventures. So there's all these new different buyer groups that are emerging. Even like well, yeah. There's so many things I can talk about, but I'll close on this one. I think the creator-led sports media businesses like is really exciting, right? Like there's 3 deals that we tracked over the last year. High Mount buying majority stake in Dude Perfect. Good Golf raising I think like a $40 to $45 million round, and then John Boy Media selling a minority stake / investment from MLB.
Yeah,
So
huge.
that space is just like exploding.
Yeah, huge.
All right, I'll close it off. And then the last one that we tracked is called like podcasting and audio. So the stat that I think is interesting, why we're seeing an uptick at deals here, is something I heard, and I did Dan Granger from Oxford Road, who was a former client, and they sold to Insignia Capital. I give him credit for this, but I think he mentioned the average consumer spends around 25% of their media time in audio, but only 5% of ad spend is in audio. So that's a big gap. And there's reasons for that, right? There's like a lack of understanding of the space, attribution, and measurement tools that need to get fixed. But as all that gets worked out, that gap is going to close, and it's going to create a lot of money for a lot of people. So yeah, I give credit to Insignia Capital, private equity firm that bought Oxford Road and Veritone One last year, combined them, and is now kind of like building a modern podcast audio creator agency. And then yeah, like we were like PodX bought Lemonada, Audio Chuck raised like I think over 40 million from the Turing Group. And then, yeah, I just wrote about Adalicious was sold to Audio Boom just over the last couple of weeks. So like the podcast space, which like the creator economy over the past 2 to 3 years was really quiet, it's really coming back in a big way.
That was a perfect synopsis of all those categories.
It's like I talk about this, every day.
The 2 that I want to dig into, and I just want to touch on the first one of more companies buying these creator businesses. It was the food company buying the food media brand. That I think is becoming more and more popular, just as you're seeing with paid ads becoming less and less efficient, and content, especially at scale, being a great opportunity to attract customers and acquire them at a really good price. I think that transition continues to speed up a lot, especially as more and more CMOs understand that connection and are just not getting the attribution that they want from their paid ads. Whether it's effective or not, the attribution is not what it was 15 years ago, thanks to a lot of the privacy stuff. That's one area. The other 2 areas is solo creators like the Dude Perfects, the John Boy Medias, that have been at it for years and years and years. Dude Perfect's been at it since I think 2012, 2015. I mean, they've been at it for 10, 15 years. Started as the classic YouTube creator, camera and them, and that's it. John Boy Media started with Jimmy started with the breakdowns, and those
lip reading and like stuff like that.
Yeah, and he became just consistent year over year. And I think those are the really interesting cases. Dr. Becky Kennedy from Good Inside, she's another good example of solo creator that has now some capital behind her and is building an amazing platform, a really good sized business that we've talked about before. But this kind of transition from solo creator to taking on investment, what questions do creators need to ask themselves as they're trying to figure out, do I want to take on investment? Who should I take investment from? What do those questions look like? And obviously the first question is, what type of business do I want? We've talked with Ali Abdal's team, who runs a really amazing $5 to $7 million business that they've talked about publicly. They don't have a ton of interest in taking on capital. Could they? I'm sure they could, based off what they've built. But how do you advise creators who are in that kind of, they've put in the work for maybe 5 to 6 years and they're trying to figure out what path to go down?
Yeah, I think I was talking about this on a panel at South by Southwest, and it's very easy to see all the headlines of like companies sold or raised millions of dollars. And it's like, that's sexy. That's exciting. And so a lot of creators will say, creators and creator focused businesses, they'll raise their hand and say, I want to do that. That sounds cool. And then they come to me and they're like, hey, Chris and the RockWater team, like, we want to go raise capital. Like, how can you help us? And the first question is, well, like, what are you trying to be? Right? Because they need to understand if they're going to go raise money, that there's responsibilities that come with that, but primarily they need to have a good business reason. Why do you need the capital? How are you going to use it to grow? How are you going to be differentiated from your peers? How are you going to deliver outsized returns for your new shareholders? Do you also understand the new accountability that comes with taking outside money, where you might have a board and you have to do reporting? And is that something that you want to sign up for? There could also be a lot more pressure to kind of grow more quickly, and that could be stressful and add strain to the founders and the team. So it always is, what is your goal with this capital, and what is the market, and what's the business opportunity? Because the founder is like, well, you know what? I don't want anyone else telling me what to do. I want to grow at this good clip. This rhythm feels right. Then I'm like, well, then why do you need money? Like, if you're generating a bunch of cash on your balance sheet, you want agency and control, and you're happy with the money that you're making, and you feel that you're very competitive and you stand out, then it kind of feels like you're good to go, right? But if it's, hey, they see more opportunity in the market and they don't have the funds to invest in team, to invest in IP, to invest in user acquisition, to do more marketing. And then they're also looking for a partner who maybe comes not just with money, but with commercial support and resources, access to brands, access to new distribution, access to new relationships and other investors. Then it's like, yeah, all right, let's paint a picture for what this new growth model looks like and what you can accomplish. And then with that, we understand what the capital plan is. And then with that, we understand what types of investors and partners make sense. And then how do we best tell the story and have those conversations to get you set up for success?
What do you mean by capital plan? Explain that.
People say they want to raise money, and then I'll be like, okay, what do you want to use it for? And then how much do you need? And sometimes they'll just say, I want to raise 10 million. I'm like, why do you need 10 million? They're like, to grow. And I'm like, well, that's not going to be good enough. If you get in a room with an investor, they're going to ask you things like, how will you use those funds, right? And then when are you going to need more capital? And then what's important for the founder to understand is if you take money, you're going to dilute yourself. And so if you're going to dilute yourself, which means that you're going to sell some of the equity of your business, then you're going to have to drive towards a bigger outcome or a bigger result that's going to make it worthwhile. Because otherwise, maybe you don't sell any stake in your business, you keep growing maybe at a lower rate, but when you exit, because you still own 100% of the company, you're making more than if you grew really quickly and sold a portion. So you have to do that cap table math and the business growth plan and the potential exit plan when you're thinking through this stuff.
What are you seeing for those businesses? And I know there's the outliers like Dude Perfect. I'm not sure John Boy Media is an outlier, but what are you seeing the numbers come in at from an investment standpoint? Is it a couple million? Is it that 2 to 10? What are you seeing numbers wise?
It really varies, right? So I would say for the Dude Perfect deal, I think it was reported that was over $100 million investment. And this wasn't disclosed, but I think it was a majority sale of the business, right? Not the entire business. With John Boy, those figures were not disclosed. But with Good Golf, I think that was like a $40 to $45 million investment. And I would assume that, the stake again wasn't disclosed, but I would assume that was for a meaningful minority position in the business. So that's usually in the range of like 20 to 40%. And my guess that would be on the higher end for this deal.
Do you see these types of businesses needing to continue to raise A, B, C, D rounds, similar to how the tech companies in the past 2 decades, 3 decades have kind of gotten on the capital train and then they got to continue to raise more and more? Or do you feel like it's some of these big initial investments, put them in a good spot, and then get to profitability from there? How do you view that?
I think we're all figuring it out right now because this is like a new model, right? I think like you said, in these traditional technology VC businesses, it was like, get a seed round to validate product market fit. Then it's like Series A to kind of continue growing the foundational team and the business and the services. Then a Series B was like, all right, we have product market fit. We have the right customer acquisition plan. Now we just need more fuel to fire. So like Series B to Series D was growth, and then it was exit, sale, IPO. That was like the playbook, right? Now with creator businesses, I don't think we have like a very clear playbook of like how much do you raise at what point and from who. I mean, what I tell people is with these creator businesses, like one, because of the nature of their business model and their content, that they have much lower user acquisition costs and distribution costs. So I think that they can actually scale much more efficiently with less capital. So I think maybe in the beginning, if you're developing like an initial product or service, like, yeah, there might be some initial funding for that. But then I think you can really start to have that initial high growth phase very efficiently with low numbers raised. But then when you really want to go big and you want, like say like brick and mortar distribution or a global team, then it's like, then you really got to be raising serious money. And that's where it's going to be interesting to see what Mr. Beast does with his business, with their planned IPO, I think at like a 5 billion valuation, because I can't wait to see the S1. I think the transparency of that deal to understand all the disclosures for how he's built his team, how it's structured, what are their financial metrics and KPIs, what are the risks that they're really concerned about, and how are they addressing them? Like clearly in any creator business, it's like key man risks. And what's their growth plan? So I think that's why we write about so many deals at RockWater, and I write about many more deals than our firm just does because we're all just learning at the same, concurrently. So the more these deals and the more transparency, it's going to be really interesting to see.
What do you think, Chris, are those signs that a creator business is ready to scale? Do you think there's some foundational elements that say this is ready for the next step?
The first place that I always go is their P&L, right? So if your question is, are they ready to scale and bring in like additional capital? I want to see just like, what's their critical mass of revenue? Because there's different thresholds where if it's like, are you meaningfully into the 7 and 8 figures? Or are you still kind of like a 5 or 6 figure business, like trying to figure it out? So I think just like revenue scale matters. I think 2 is revenue diversification. So are you just making money from programmatic like AdSense and Snap? Or are you doing also direct sponsorship deals, larger campaigns, you selling subscriptions, live events, like whatever else? I want to see diversity in your revenue lines. Then I want to see like meaningful margins. Are you selling $1 for 90 cents, or are you actually able to deliver a good service, a content experience, entertainment experience, and keep margin at the end of the day? And then how fast are you growing? Like, are you piddling along at just like lower than inflation, like lower than like 2 to 3%? Or are you really growing in a meaningful, outsized way? And then lastly, like, do you have an ability to hire and build a team around you, or is everything solely reliant on you? Those are some of like the core financial and team qualitative metrics. But then there's other and I think Slow Ventures does a good job on this of looking at understanding the audience, the community, how engaged they are, what's their sensibility, what's the market opportunity for the space that they're in, how big is it, and how many competitors are out there, and what's your value prop. I think you'll start to look at all those things and put that together with like the financial learnings, and you can understand if a creator's ready to scale or scaling in a sustainable way.
Similar kind of criteria to what traditional VC has used for the tech side, obviously applying those to the creator side. And I think one of the interesting parts about the creator side that you mentioned too is is it a legit pain point? Is this creator and is it entertainment, or if they're on the education side, are they solving a real genuine pain point? And I think Dr. Becky is a great example of that as well. Of parenting is one of the most challenging things, if not the most challenging thing that you can do. And there hasn't been a lot of good resource around that. Pain points are important. And we talked about it earlier, but 2014 to 2022, just trying to find a problem that didn't exist, with a solution there, that it doesn't matter if they're a creator business or if they're a technology company, it's not there.
Yeah. The whole like solution in search of problem. So for example, I invest in real estate on the side, along with my twin brother. We have a portfolio in Savannah and in the Midwest. We're figuring it out as we go. And so it's like, all right, well, there's a lot of different quote unquote gurus out there. Like I remember like reading different real estate books growing up. And then there's this guy like Ryan Dossey, who's just created these incredible YouTube videos where he has built an awesome diversified real estate business himself. He owns a portfolio, he provides different services, also technology platforms. And then he just puts out a lot of free knowledge and information of like his learnings, his missteps, how he has scaled and all that stuff. my brother just like voraciously, devoured all that content. And then we actually ended up signing up for a mastermind where we had more direct access to him and his investment community. We did that for a year and it was helpful, learned a lot. And so he's just one example. Like he's in a certain niche, like real estate, rental, investing, and services. And there's so many others that are out there. So I think that's also part of the equation is like, are you in a niche? And in that niche, are there different ways to monetize based on who your audiences are? And then how big is that niche? If it's small, you can still build a great sustainable business as maybe like a founder owned and controlled company. But like if it's a really big market segment and there's not a lot of competition right now, then it might be a world of like, there's a much bigger thing to go after. And that's where having capital could make sense, or selling to another strategic partner and going after that bigger opportunity together.
Real estate is such a good example too of when you have all that free content, giving your audience that next step of I'm ready to pay. I've watched 300 of your videos, 200 of your videos. I'm all in. I'm ready to go. I've got this pain point, and the mastermind was that for you guys. Ali's talked about this as well on his side of before the playbook was give away free content for years and years and years and then monetize. But when you're in all these kind of niche areas, you don't have to wait to monetize. You can monetize much faster now because people are wanting those next steps. It might not be 100% of the audience, but it could be 10, 15%. But that's going to give you a really meaningful business if you do it properly and deliver properly.
I mean, yeah. Like I'll talk about RockWater. Like we use content for our customer acquisition model, right? So I started my career on Wall Street 20 years ago, and I worked at a boutique bank focused on digital media, cable, telecom. And it was like any other Wall Street bank where the majority of my time as an analyst was just spent pitching. You're just going to bake-offs, pitching against a bunch of other banks, and you really feel like a commodity. Like, these clients don't care about us. They're just like, who's going to do the most work for free and who has like the best rate card? There's more to it. I'm generalizing, but like that's what it really felt like. And that was true and is true today. And so in building RockWater, I was like, okay, one, there's a void of specialist M&A advisors for the space. I have a really unique pedigree and background where like I've been at early digital media companies, early YouTube native and influencer marketing business, help build it, scale it, sell it, all the things. And I was like, there's no specialist advisor that is servicing this like growing industry. And I want to fix that void, but I don't want to do what I did 20 years ago. Right. And so we're like we're a B2B creator. So every day we post on LinkedIn about different deals that we're seeing and industry observations and trends. We also have a very widely read weekly M&A newsletter covering different deals in the space. And then we host executive events, now throughout the world about like once every month or so, right? I've done it at South by and VidCon, Billion Follower Summit in Dubai, like you name it. And so the majority of my time is really on content and marketing and servicing our premium clients. But I mostly get clients because they are inbounds to me. It's like, hey, I've been reading your articles, I've been watching your videos. And yeah, now we're starting to syndicate our content to like Instagram and YouTube, which is a whole new muscle for us. But they'll be like, hey, I've been tracking your content and the deals that you do. Like, I would love to get on the phone with you or talk through it. And I think that's a much more fun way to build a modern investment bank. And it also allows us to really understand more like our clients' business models because we're building a very similar thing over here. I also think it adds enterprise value to the business that we're doing outside our M&A services. And I like it and it's fun. I think it's a very different model than any other bank is doing that's out there. And I think it really makes us, stand apart. And that's an example of like, do I think there's a large global audience for like greater economy M&A? No, but it's a niche with a very high willingness to spend if you're looking to sell your business.
Yeah, for years, content has been kind of a secondary thing, and more every single niche, whether it's M&A, it's lawyers, finance, parenting, it's all just coming more and more to content, and then building those funnels, like you said. You don't need a giant audience to make the business, work really, really well financially on your end and the opportunities on your end. Let's talk about the exit, Chris, and how you're looking at P&Ls, how you're looking at just creator businesses, outside of creator businesses as well. What are those kind of red flags that buyers are looking at and not turned off by, but just are really hesitant? What makes buyers pretty hesitant? And again, you can talk about it in the context of those four categories that we've talked about, or within creator businesses, however you think is best?
So I'll say 95% of my job is getting on the phone with founders and owners and investors who want to sell their business and me telling them why they're not yet ready for a sale. And that's why it's not like I'm trying to, I'm very positive and optimistic about the space and I want to see people win, but I want to see good deals happen because more good deals means it's better for everyone. It attracts more capital, attracts more buyers. Like bad deals caused what happened between 2022 and 2024. Well, that was a correction. That was tough on a lot of people. Yeah. So like things that I look for is, one, all of the kind of like financial characteristics and KPIs that I previously walked through, right? Revenue critical mass, margins, diversification. Concentrations are an important one. I think more people should really focus on that. Team, all that stuff. And what's like the market size and opportunity and what's their actual unique and differentiating angle. But on top of that, I also look for like, what are your expectations? And if their expectations are very different than market precedent, where I'm like, hey, in this market, these companies typically trade as a multiple of EBITDA or revenue or ARR. And here, here's the value range. And then typically here's how those deals are structured as a mix of cash, stock, earnout, etc. If the seller has very different expectations, then I'm like, yeah, we're not a good fit for you because we're going to take you to market. We're going to go and talk to all the valuable buyer relationships that we've like built credibility with over time. They're going to give you an offer or a deal, and then you're going to say no. So like, why don't we just like not waste anyone's time? So I think value expectations to market is important. And then also, I just call it like the human and emotional wherewithal to go through a sales process. Like M&A is very intense. There's high highs, there's low lows. A good advisor will shield you from a lot of the work, but like you're the one selling the business. So you're going to be very involved in the diligence, in the management meetings, working on the new combined growth plan with the acquirer, doing the roadshow. So you have to be ready to manage that while also running the day-to-day business and driving good performance and growth. Because the worst thing that can happen is you take your eye off the ball in the business, your financial KPIs start to deteriorate, and then you lose a lot of leverage in the sales process, or you're not attractive anymore. And you also lose your leverage because we might take you to market. You can design the best process as possible, but the market really is going to inform the result. And you always want to have a BATNA or like a best alternative to a negotiated agreement, which is we can just walk away and continue running the business. So that's not easy to do. So I look for people who are ready to have like good team, good systems in place, know what they're getting into, and then we have the confidence that's like this team's ready to go to market.
What do you think the biggest misunderstanding on the buyer side is currently? Is it a lot of the misaligned expectations of how the earnout or equity or cash works? What category is just there's still too much misalignment on or just misexpectation?
Spent a lot of time on buyer education. We want to do that because it's good for the long-term picture of the space. We want traditional media companies getting involved. We want non-media companies getting involved, like I talked about earlier, and different investors wanting to figure this out. But yeah, like as the space has grown, there's companies that have, wheeled and dealed in the creator and digital and social media space before. They know the questions to ask. They know the typical diligence processes. They also understand that in this space, deal making is a bit more informal. It's not as like rigid as like what I saw in traditional Wall Street 20 years ago, which is like the seller never talks to the buyer without the banker present. And like there always has to be a strict 2-round, M&A auction. It's like, I don't think that really makes sense anymore generally, but it's definitely not how a lot of deals in this space happen, right? It's more informal, more flexible. So yeah, like a traditional media company or a non-media company, they don't understand these business models well. This is new forms of distribution, new different types of talent, new forms of monetization. The P&Ls look different. So getting them up to speed on like the financial presentation, what are the KPIs to look for, how these companies are actually valued, and what is the kind of like current market valuation ranges. Because if a buyer wants to get involved, I mean, like, don't waste your time. Like, I'm going to teach you how to look at these businesses, but you have to give a fair a fair market offer. Otherwise, like we're not going to look at it. So we spent a lot of time doing that for sure.
I got a couple last rapid fire questions here, Chris. They don't have to be rapid fire answers. My first one is, what's a recent deal or company that's gotten you genuinely excited about the future of the space? So it could be just a recent deal, and I know you mentioned a bunch of them, but what's one that's got you really, really excited that you maybe didn't expect, or was just surprising?
Look, I like saying all the deal activity in the different categories that like I just kind of like walk through. Like that's really exciting to us. And we have clients in every single one of those categories. So I think like a great landmark deal was our client Long Haul Management selling to Wasserman, a global Hollywood sports agency. It was an incredible win for Dan Levitt, who I known for like over a decade. We worked together at Big Frame. This was like over 12 years ago. And then he left, went on to build this big business, bootstrap, no outside capital, really captured this niche in called like sports, gaming, lifestyle creators, and then saw like a global Hollywood agency backed by big private equity, by Providence, start to make a meaningful investment into what's now like the Wasserman Creators Division, because that deal was preceded by J1S. That was a total landmark deal in the space, and I love the story, and it was very personal to me, and a great win for our RockWater team, and we delivered a great result. So like I love that one, right? Another one, I just love seeing the activity in the podcast and audio space. We're actually bringing a really large podcast sales and talent sales business to market over the next few months. And I think it's going to get incredible buyer reception. But like I give a ton of kudos to Insignia Capital stepping up last year and buying Oxford Road and Veritone One and putting them together for this big new call like podcast agency services play. And we worked with Oxford Road kind of like early on when they were considering their strategic options. And then I feel like that deal just caused like, you just follow the deal activity that happened after that, the ones I was listening to earlier of like Lemonada and Adalicious and Audio Chuck and Wonder and Acast. Like it just opened the floodgates. And so I love seeing that. And then, I think similar in that lane, I also close it out with Fox, traditional media company, one, investing into Whaler, but two, investing into Red Seat Ventures. And we know the founders, Chris and Kevin Balfe, well. We have advised them on various projects over the years. They are like some of the sharpest minds in the space. And they have built this business that helps different called personalities, typically conservative leaning, build D2C media businesses, and they've done it very well, very effectively. And then Fox kind of going through like an existential issue with all the talent leaving its business and saying, hey, they're all going to Red Seat, right? And now we need to find a way to like, what's a new way to work with these talent? And it was like RSV figured out the model, and now we're going to bring them back under the Fox umbrella. And then they put them under their like digital and Tubi division. Like I love seeing those deals.
Full circle moment.
Yeah, 100%.
That's awesome. If you could invest in one creator business right now, what would it be?
This is tricky because the way that I invest my money, Thomas, I'm going to give you like always like a longer answer versus rapid fire.
That's all right.
I spend so much of my time advising these businesses and generating fees from our M&A and strategy work that I really believe in like call it diversification of my personal family office, which is why I invest in rental real estate. It's like you can touch something tangible and hard, and I get a rent check every month. I really like that. But I would say in any of the categories that I walk through, with the right, to me it's any of those four categories with a really great talent management team or management team, I'm sold. Now I'm thinking about one company that we're bringing to market. They're an e-learning business. What I love about them is they have really built a new, very meaningful revenue line for creators, where they essentially go and identify like someone who's got a business on Kajabi or something, and they're making, call it $50,000 a year. They're like, you should be making $500,000 a year, right? We're going to teach you how to better program that content, better market and sell your services and create that whole conversion funnel. no outside capital, growing like a weed, super profitable. They're just absolutely crushing it. They're a client of ours. We're going to bring them to market for a sales process. But if I could put money into that business, like what they have just figured out is absolutely fantastic, and I would do that all day.
Thanks for listening to this episode of the Creator Ops Podcast. If you're interested in chatting more about the creator economy, send me a message on LinkedIn or email me at thomas@creatoropsmedia.com.